Welcome back to part 4 of the Real Estate Investment Growth course, the most practical and financially powerful part so far. If you completed part 1, 2, and 3, then congratulations, you're no longer just learning real estate, you're transforming into a financially intelligent investor. Today's lesson is about financial analysis, cash flow mastery, and global wealth building morals. The exact skills used by investors in Los Angeles, Miami, Dubai, Singapore, New York, and London to grow properties into long-term wealth machines. This is the part that separates amateurs from professionals. This is where people either become millionaires or get stuck with properties that drain money instead of generating it. Let's begin. Most beginners obsess over property appreciation, but professionals know cash flow is king. Cash flow determines whether your property pays for itself, whether you survive a recession, whether you can keep expanding your portfolio, or whether banks treat you as a high-quality borrower. The US real estate market, especially states like Texas, Florida, North Carolina, and Ohio, is built on cash flow-focused investing. Reports from the National Association of Realtors consistently show that investors with positive cash flow have 40% higher long-term portfolio growth than investors dependent on appreciation alone. Cash flow gives freedom. Appreciation gives hope. Serious investors choose freedom. A property with even a modest cash flow of $300 per month can accumulate to $72,000 over 20 years while increasing in value. That is why wealthy investors like Grant Cardone, Barbara Corcoran, and Robert Kiyosaki repeatedly emphasize, never buy a property that doesn't pay you monthly. This is the rule that keeps investors wealthy and even during recessions, inflation, and war. This segment turns you into a financially literate investor, the kind banks, lenders, and partners take seriously. ROI, return on investment. This shows how much profit you earn from your investment. Professional investors target 8 to 12% ROI in the USA and 12 to 25% in developing markets. Cap rate, capitalization rate. Cap rate determines how quickly your investment pays itself back. 4 to 6% is equal to high demand luxury zones. 6 to 8% is equal to stable suburban areas. And 8 to 12% emerging or high risk markets. According to CBRE reports, US multifamily cap rates average 5.2%, while markets like Texas offer higher yields with stable tenants. DSCR, which means debt service coverage ratio. Banks use this to see if your rental income can cover your loan. A DSCR of 1.20 or higher is ideal. The investors who understand these three metrics make smarter decisions and grow their portfolios faster than those who guess based on emotions. When professionals analyze a property, they don't ask, "Is this cheap?" They ask, "Will this generate long-term wealth?" Here's the exact analysis checklist used by US real estate analysts and private equity firms. Rental demand score based on population trends, job growth, and local development. 5-year appreciation forecast using data from Zillow, Redfin, and government housing reports. Vacancy rate. Healthy markets have below 7% vacancy. Local economic drivers. Universities, hospitals, ports, tourism, manufacturing hubs. These create enduring tenant demand. And cost to rent ratio. If monthly rent is at least 1% of property value, cash flow is strong. Professional investors analyze properties like surgeons analyze x-rays. They don't guess, they diagnose. This is how investors in Phoenix, Houston, Charlotte, Austin, and Chicago grew portfolios even during inflation and economic uncertainty.
Well, viewers, if you didn't subscribe to our channel yet, please subscribe now.
Financial planners worldwide, including experts cited by Forbes, Bloomberg, and Investopedia, repeatedly highlight the 50 by 30 by 20 rule for building long-term wealth. 50% essential property expenses includes taxes, insurance, maintenance, and management. If expenses exceed 50% of rent, cash flow collapses. 30% loan payments. Mortgages should never exceed 30% of your rental income. This is the same model used by US institutional landlords. And 20% profit and future growth. This is the golden zone. This is where rental wealth compounds. This 20% becomes your savings, expansion capital, and financial freedom engine. In the US, REITs, real estate investment trusts, and larger property companies follow variations of this model to ensure consistent profitability. When you apply the same rules, you bring your portfolio to a professional level, even if you're just starting with one property. This rule ensures you always stay profitable, even during inflation or rising interest rates. Generational wealth is not accidental, it is structured. Real estate creates multi-generational wealth because it appreciates consistently. It produces monthly income. It can be refinanced to create more wealth. And it can be passed to children with tax advantages, especially in the USA. Wealthy families in the US, UAE, and Europe use long-term rental portfolios to secure stability for generations. According to studies published by Harvard's Joint Center for Housing Studies, families with multi-property portfolios build 5 to 10 times more wealth than families depend on salaries. You don't need 50 properties. You need the right 3 to 5 properties that grow, cash flow, and multiply. A single well-located house in Florida or Texas can become a retirement plan. A duplex in a growing city can support future generations. Real estate doesn't just make you wealthy, it makes your family wealthy. If you want to invest like high net worth individuals in the USA and worldwide, use the global portfolio strategy. Step 1. Start local. Buy your first rental property where you understand the market. Step 2. Expand regionally. Move into fast growing cities with population growth. Step 3. Add a safe, stable foreign market. For most investors, this is the USA due to strong legal protections and stable cash flow. Step number 4. Add inflation-proof assets. Land, multifamily rentals, and commercial leases. And step 5. Maintain 20 to 30% liquidity. Cash reserves protect you during crisis. This is the exact strategy used by global investors in Dubai, Singapore, Canada, and the US to protect their wealth from inflation, war, recession, currency devaluation, and political instability. This is not just investing, this is engineering a financially secure life. And that completes part 4 of the Real Estate Investment Growth course, your guide to mastering financial analysis and building an unstoppable investment portfolio. If you've reached this point, you're not a casual learner anymore. You're becoming a strategic, global level investor. To unlock part 5, comment below. Part 5, please. Don't forget, like, subscribe, comment. Share this course with someone who wants financial freedom. Part 5 will be even bigger, even more practical, and even more powerful.